Okay, let's start because I think we already have something like 80 participants that have joined the meeting and can hear our exchange. Welcome to all, 86 exactly. So welcome to all. My name is Céline Kauffmann. I head the Entrepreneurship SME and Tourism Division in the Center for Entrepreneurship SMEs Regions and Cities at the OECD. And together with Monica Scatasta, with the Director of the Technical Assessment and Monitoring Directorate at the CEB, and the team on both the OECD and the CEB side, it is our great pleasure to welcome you in this joint event of the OECD and the CEB on mobilizing SME finance for a resilient, sustainable, and inclusive recovery. As you may know, on our side, this webinar is part of a series of events that the OECD is organizing this week on the back of the United Nations MSME Day, which took place on Monday, 28th of June. And that day, our new Secretary General, Matthias Kormann, launched the 2021 SME and Entrepreneurship Outlook, which is a flagship report that we publish every 2 years, and which for this specific edition offers a detailed assessment of the opportunities and challenges faced by small businesses and entrepreneurs in the COVID-19 crisis and the recovery. And every day this week after the launch on Monday, we are hosting virtual events to explore the most critical issues for SMEs and entrepreneurs. So just to give you a flavor of that week, on Tuesday, we focused on women entrepreneurs. Yesterday, on Wednesday, we had the specific focus, 2 webinars on digitalization. And tomorrow, we are going to focus on the role of higher education to build entrepreneurial skills. So today is dedicated to finance. And why focus on finance? Because obviously for us, SMEs are at the heart of the crisis and they are central to the recovery going forward. And if access to finance is a key long-standing issue for SMEs and has not obviously emerged only in the crisis, to some extent, the current context compounds the challenges that SMEs are facing. And the profound changes brought about by the crisis, as well as the longer-term trends such as digitalization, innovation, require significant investments from SMEs and entrepreneurs. And on the other hand, as we will be discussing today, there is a question mark on the investment capacity of SMEs going forward. So you may know that the OECD has been working in this area for a long time. We've been producing the SME Finance Scoreboard for more or less 10 years. And the scoreboard is really our flagship tool and monitoring tool that provides evidence on SME access to financing conditions, and government policies. We've also developed the G20 OECD high-level principles on SME financing, which aim to promote a diversified financing offer for SMEs. Today's event for us is extremely timely, as much of the world begins to switch gears from crisis management and support to recovery. The stakes are very high for SMEs, and we need to get the financing environment right to ensure that SMEs are fully mobilized for an inclusive recovery and for the key transitions ahead, in particular, the green and the digital transition. And so it's a very great pleasure to actually partner with the CEB, Monica and her team, for this event, as we share a common interest in mobilizing SME finance for sustainable and inclusive growth. And so without further ado, let me actually hand over to Monica to provide and deliver the opening remarks. Monica, it's a pleasure, and over to you for your opening remarks.
Thank you, Céline. Thank you, Céline. The pleasure is mutual, and indeed the Counsellor of Euro Development Bank, which I will call CEB from now on, is extremely pleased to be co-hosting this webinar today as part of this important series of virtual events. And these events and the work of the organizations behind it, the OECD and the other organizations that have been involved in these events are crucial in our views today, as Céline was already saying. And this is because in the end, MSMEs are really the gel and the key elements in the fabric of our economies and in fact of our societies. Just to give a few figures, which may have already been given in previous events, but just as a reminder, you know, MSMEs represent about 90% of businesses worldwide, and according to the World Bank, they account for about 50% of employment worldwide, and the figures are even higher in the wider European region. In the EU, they represent 99% of all enterprises and employ about 2/3 of all workers. And in some areas, such as the Western Balkans or even the Baltic countries, this goes up to 80% in terms of employment. So today, in my remarks, I will focus primarily on the wider European region, but some of these considerations are broader. And this is also because the CEB is the Social Development Bank of the European region. And as I said, for our 42 member states, the MSMEs play really a very big role, and an even bigger role than worldwide, as I was saying just now. But in addition to fueling economic growth, MSMEs are also crucial in achieving sustainable development goals. And as Céline was saying, is really being the driving force behind what we want to see as a really inclusive, green and resilient recovery. They can create employment opportunities, they can foster social inclusion and economic empowerment opportunities for the young, for women, migrants, for the people that have encountered and continue to encounter limited opportunities compared to other groups. They can help provide key social services such as social care, and can play a really key role in the green transition, particularly if they can embrace a circular economy approach, or when they can invest in energy efficiency. But importantly, they can foster all of this by also supporting, either investing in other ways, in a technological innovation, but not just technological innovation. I think sometimes we forget social innovation that leads to true social integration. And I think that this is an aspect that I would hope is also discussed. And I believe the social agenda indeed cannot actually be achieved if we don't ensure that the MSMEs have the instruments, are able and have the incentives to contribute to it. In addition, we know today more than ever, I guess, that the MSMEs must become more resilient to disruptive events and to long-term trends. We'll talk about COVID in a second. I'll say more because it's also one of the key topics also addressed by the OECD's recent publication. But we also need to make sure that increased resilience to climate change, both in terms of local impacts and impacts along vulnerable value chains, is taken into consideration. So let me just pause for a second just to share with you my feelings about something, my sentiment. And the way in which I see MSMEs goes beyond a crucial element of our economies. I really see them as the key element in the fabric of our communities. It's where we meet, it's our bakeries, it's our coffee shops, it's what makes our towns and cities lively and makes them feel humanly connected. It's where young people develop their dreams and start a new way of building the future. It's where migrants and other vulnerable people can start making a real economic future for themselves and changing their own future and changing ours in the process. So I think that the current crisis and its impacts are not only going to be felt in terms of lost jobs. It's not those statistics only that are going to be the consequences of the crisis that we are facing, but this will have much broader implications unless we are able to actually turn the tide. So today we're here, in fact, to discuss how finance may help turn this tide. And as Céline was saying, what does it take to improve access to finance, and especially to the right type of financial instruments for MSMEs and other instruments, not just financial instruments, other types of support as well. What has been the impact of the COVID crisis so far? What could be its long-term and long-lasting consequences? And we want to look ahead at solutions, looking at the way that finance can help ensure that MSMEs contribute to building an inclusive, green and resilient future and does not become part of the problem. And I think this is also going to be an important aspect that the second panel will address. So what we know, and in fact we have studied also directly, is that indeed access to credit has been one of the key challenges for MSMEs. Even before COVID, despite high liquidity, favorable economic condition, lower interest rate, even before COVID hit, this had not improved. And a research that CEB carried out with Professor Rodríguez-Pose, who will be speaking in the first panel, covering over 22,000 manufacturing firms in 11 countries over 7 years, confirmed what most of us felt, that smaller firms actually have even more difficulties accessing them. And there are a number of factors for that I'm sure Professor Rodríguez-Pose will address in its intervention. The CEB, to address these difficulties in accessing finance, has been very active in supporting MSMEs, which have represented about a third of its portfolio over the last decade, for around 10 billions in financing through financial intermediaries. And 2/3 of that went to MSMEs in target countries, mainly located in Eastern Europe and the Western Balkans, where access to credit for MSME is even more challenging due to a number of factors, such as tougher lending conditions, higher real interest rate, complex application procedures, higher collateral requirements due to regulatory requirements, etc. And so we've been very much involved in working with financial intermediaries, and we'll see in a second also what other specific types of financial intermediaries. But let's turn to COVID for a second. As we said, and as Céline was saying, the past 18 months, the situation has got a lot worse. In particular, MSMEs have been concentrated in many of the most affected sectors, such as tourism, hospitality, retail, and certain geographies have been hit particularly hard because of that. And the OECD SME and Entrepreneurship Outlook actually showed that in Greece and in Italy, MSMEs account for nearly 90% of employment in the sector that were most affected by COVID. So indeed, these interpersonal but also interregional inequalities have been spiking as a consequence of COVID and of the measures that were needed to address the sanitary situation. So as the COVID crisis unfolded, access to finance became a question of survival, also for many otherwise viable and well-functioning MSMEs. And again, the outlook, the OECD outlook showed that 20 to 40% of MSMEs in OECD countries have received some kind of government support, subsidies and other forms. And indeed, in the EU, a 3.7 trillion COVID response package was launched, and other financial institutions responded. I'm thinking of the EIB Group and the Pan-European Guarantee Fund, for instance. And clearly at CEB, even with smaller numbers, but we've played a part and adopted a real rapid response. Just in 2020, our lending volumes increased by 50%, and over 50% of our lending volume went to COVID-related projects. And let's say from last April to now, we've approved about almost 4 billion in loans that are related to COVID, of which about 1 billion to support MSMEs, either through financing financial institution or through budget support for activities for let's say national job retention schemes supporting workers at risk. But there's one important point in all of this. All of this support may not have reached necessarily the smaller SMEs. A lot of this has been actually captured by mid-caps. We've seen it recently in the monitoring of one of our COVID loans that shall remain unnamed, where in fact this was the case. And therefore there is a need to really think and ensure that the support reaches the intended beneficiaries. But now as Céline said, it's really important to really take stock of the crisis, but look beyond the crisis. And so the question is, how do we make sure that we support a new way of doing business for MSMEs? that supports the SDGs, as I was saying earlier, and that really takes us towards this greener, more resilient, and especially more inclusive, especially I say it from the CEB perspective, future. And I think that in this area, there is a need to think of both the type of financial instruments that we provide and that can be provided, but also the type of counterparts that we work with. And indeed for CEB, an important, increasingly important area of operation has been microfinance. And I think that this is an area where really, if we want to look at social innovation, social inclusion, this is an area where we see really the importance of focusing support. In recent year, we've been also focusing on also smaller microfinance institutions that present a riskier profile, and therefore the fact that the CEB can also provide guarantees for MFIs is extremely important. As I said, what type of support do we provide, but also what type of non-financial support do we provide? So again, just to give you an example, we have been providing quite a bit of capacity building and grants for technical assistance. And I give you an example from my country. There's a microfinance institution called Permicro, with which we've been working for a while, and we've provided TA support to support a specific program where they've been working in social reinsertion of former convicts, called I Start From Here, Ricomincio da Qui. And more recently, we've approved another grant to support, in particular, skill enhancement for women that had been that had suffered from domestic violence. This is the type of support that can make really an enormous difference in terms of fostering social inclusion. I don't want to go on for much longer, but I want to open another small door, which is the possibility and the looking for instruments to support also social enterprises. This is so difficult. They need equity very often, or some sort of subsidized support. And we've been looking for those type of aggregators that can enable us to reach also this type of enterprises. We're looking at one right now, but we haven't yet concluded the appraisal, so I cannot say in which country. Cooperative banks are also in another area, another counterpart that we believe is going to be increasingly important, at least for us. And let me just give you an example. In Greece, Carditsa Bank. Why do I choose that? Because this is also a way for us to support the green transition. And in this case, the climate resilient transition. We're in dialogue with Carditsa to look at ways in which, given the prevalence of farmers in its client base, how can we understand the climate related risks for their client base and also for the institution. So these are just a few examples of how and in what way, also by thinking outside the box, by looking beyond financial instruments, we can really try to identify counterparts, types of projects, and types of activities that can lead to a real enhanced social inclusion and a greener future. So let me stop here and turn to today's discussion. I think that, the two panels are going to be, in my view, quite exciting. And the first will focus indeed on how MSMEs can regain access or continue to have access to much needed finance and other types of support, including advisory services, as I was just mentioning, to ensure a rapid, sustained and sustainable economic recovery. And then the second will focus really on one of the points that were highlighted by Céline and by the OECD Entrepreneurship Outlook. How do we ensure that finance does not become part of the problem, as support measures have also led to increased debt burden for MSMEs. So finding solutions to that will also be crucial. So these are crucial questions, and therefore I believe that we're going to have a really, really exciting discussion. And I wish, therefore, to all the panelists and the participants, a very fruitful debate. So thank you very much.
Thank you, Monica. Good morning, afternoon, and evening, everybody, for the ones logging from different time zones. Thank you, Céline, for the introduction, Monica, for setting the scene. My name is Isabel Brun. I'm head of strategic development at the Council of Europe Development Bank, and we're here today to talk indeed about how to mobilize SME financing for resilient, sustainable, and not the least important, an inclusive recovery. So this first panel will discuss finance mobilization with 4 great speakers, whom I'll present to you in a moment. Micro, small and medium-sized enterprises are the engines of the economic development and employment. As mentioned before, they account on average for 60% of total employment and 50 to 60% of national value added in OECD countries. They're therefore essential to the recovery. They're not only the best driver for the recovery, but the recovery won't happen unless SMEs are doing well. So overall, SMEs, like all of us, have faced an unprecedented situation during the crisis. The ones that have managed to stay afloat are often facing high levels of debt. So for SMEs to play their role now as employers, including at the local level, thereby addressing some of the inequalities that we can see. Also drivers of innovation, and Monica said it, technological, but also social innovation, as this was well observed during the crisis. For SMEs to play their role, they need to be able to enjoy financial backing, sustainable means of financing at every stage of their business cycle. The OECD just issued last week its 2021 edition of the SME and Entrepreneurship Outlook, which brings new evidence on the impacts of the crisis, including on SME financing. And we'll hear shortly from Miriam Koreen on that and more work the OECD is doing in that sector. At the CEB, we finance MSMEs via financial intermediaries. This is a major pillar of our activity, as underlined by Monica, including a solid and growing portfolio of microfinance activity. What I always found remarkable at the bank is the proximity we managed to maintain with SMEs. We have first-hand exposure when visiting SMEs during our due diligence and monitoring activities. And this really helps us understanding the actual challenges they face, the importance of financing for them, mainly access the financing altogether, but also at a decent interest rate. It also helps us see the differences as well as the commonalities across the countries and regions within the same country. So this empirical experience has been the basis for a study that we published last year on credit constraints, regional institutions, and the economic performance of SMEs. Maybe somebody can put the link in the chat. This is a pre-COVID study, but the conclusions are still very relevant. And if anything, the findings have been exacerbated during the crisis. Abundant liquidity on the markets doesn't mean financing reaches SMEs, and capital misallocation results in missed opportunities for countries and regions to transform their potential. Professor Andrés Rodríguez-Pose may tell us a little bit more about this in a short while. And this brings me to the panelists. I'll stop here and I'm delighted to welcome on this panel today, Miriam Koreen. Miriam, you're the Senior Counsellor on SMEs at the Centre for Entrepreneurship, SMEs, Regions and Cities of the OECD, where you've been working since the year 2000 and for a large part on entrepreneurship and SMEs. You'll be providing us with insights on the impacts of the crisis on SME financing, amongst other topics. I also welcome Rodney Boyd. Rodney, you're a Senior Policy Manager at British Business Bank, which is the UK's government-owned economic development bank, dedicated to making finance markets work better for smaller businesses. You, at British Business Bank, you lead work on sectors, on green finance, net zero, and ESG. So you'll tell us what you've been observing, and when it comes to helping SMEs access finance, what has been developed during the crisis. We also welcome Gerard Humer, the Chief Economist of SME United, which is an association of crafts and SMEs in Europe with around 65 member organizations, over 30 European countries. And so today, Gerard, you'll be the voice of the 24 million SMEs in Europe. And Professor Andrés Rodríguez-Pose, you're the Princesa de Asturias Chair and Professor of Economic Geography at the LSE. Amongst others, you're a recognized expert in regional science, and you will speak to us about the geographical disparities in terms of SME finance and the role of local institutions. I'll ask all of you to be very brief, since we only have 45 minutes, and we'd like to give the audience a few minutes for questions and answers. So without any delay, let's start with Miriam. Miriam, access to finance has always been an issue for SMEs, exacerbated during the crisis. Based on the OECD's recent work, can you tell us what the findings are in terms of the impacts of the crisis on SME financing and the derived consequences?
Thank you. Good afternoon, everyone. It's a pleasure to be here today, and I'm glad to see so many people joining the discussion. Yes, I'd like to just discuss a few points in relation to the impacts of the crisis on SME financing and some of the priorities going forward. A lot has been said. In our SME financing scoreboard, we track access to finance and financing conditions, as well as policies from year to year. And our 2020 edition, which was in the run-up to the crisis, actually hit against the backdrop that was really showing favorable financing conditions, but weak SME loan growth. On the other hand, we saw a big surge in the uptake of alternative financing, be it asset-backed finance, online finance, equity finance. So that was a very positive trend that we saw in the run-up to the crisis. Now, on this slide, actually, this is data that's never been shown before. So you're the first people to see it because we're in the process of preparing the 2022 edition of the scoreboard, which will include data on what happened in 2020. Up to now, we had the sense that lending was holding up in 2020 thanks to government intervention, but here we actually have the evidence that shows that this is the case in a large number of countries. Government stepped in very swiftly because, as it was said earlier, SMEs were very hard hit owing to the sectors they operated in, but also because of their weaker cash flow position, and in general having fewer buffers against these types of shocks than maybe larger firms do. And we saw government step in very strongly with a range of instruments. Here you can see that the trends in different regions of the world, actually, and then in the second side of the chart, you can see it actually by country. We don't have all the country data in yet, but these are the ones that have already reported their data for 2020. Many of them, we could actually see a reversal of a trend, a downward trend in lending prior to the crisis. So this shows that really government support has played a strong role. We do see some outliers, and I think we have to be careful in interpreting the data because in many countries, a lot of the support came through grants and non-refundable, non-repayable support. So in countries, for example, like Ireland and the Netherlands, where you see a slower growth, negative growth in SME lending, these countries did resort to other types of support as well. So, but still, this gives a general picture that in 2020, lending was boosted by government intervention. What we don't know is what's going to happen as this type of support is starting to be pulled back. So that's a key finding that we have in terms of impacts of the crisis. Maybe we can move to the next slide. As I just mentioned, governments resorted to a range of instruments to support SMEs. And here you can see in the red box the different types of financing instruments where most of them, the bottom two relate to supporting credit, and there were also grants and subsidies and equity instruments. And you can see clearly here that equity was not the most widespread form of support, especially in the early stages of the crisis response. This is evolving now. So we do have some concern about this positive trend of diversification that we had seen in the run-up to the crisis, and we want to make sure that there's not too much backsliding on this progress that was made in helping SMEs have access to different types of instruments. If I could say a few words about, not yet. When we look ahead, what are the things that we need to consider and keep in mind? First is the need for continued financial diversification, as I just mentioned. And this includes the possibility of governments partnering with alternative finance providers. We know that in the immediate aftermath of the crisis, they turned to partners that they were used to working with. These were the banks that had the networks, that had the access to the SMEs. But going forward, it would be important to broaden the range of partners that governments are working with to channel their support. I think it was also mentioned earlier that we would like to see a better targeting of measures. We know that in the initial crisis, the urgency was just to get the funds out to as many businesses as possible. There wasn't a lot of screening necessarily. We've heard instances where the funds may have gone to larger enterprises or those maybe that were not the most in need. There's also the issue that much support may have gone to businesses that are not viable. So this is something that needs to be at the center of the preoccupations going forward, and how to identify what is a viable SME, how to determine this in the current context where some of the more traditional credit risk assessment tools may not work as well. We have to keep a close eye on the debt burden of SMEs and the potential increase of non-performing loans and insolvencies. This is something that's going to be the center, the focus of the second panel. And then the last point I'd like to mention is about support to meet major challenges such as digitalization and the green transition. And there, if you could just move to the next slide. I'd like to just dwell a minute on the question of sustainable finance, because this is an area where SMEs face specific challenges beyond the ones they face for financing in general. And the challenges lie both on the supply and the demand sides, including raising awareness and incentivizing behavioral changes among business owners, as well as creating consumer demand, which has been another obstacle that's been identified as a challenge in this area. And this is also an area where specific financing instruments may need to be developed. Here, the engagement of the different actors in the SME financial ecosystem is extremely important to enhance access to finance to support SMEs' green transition. This means engaging with banks, private banks, but also public financial institutions who have a very strong relationship with SMEs and who can take on some of the risk in these projects. It also means having stronger interactions with ESG intermediaries, which is an area where SMEs have had difficulty engaging up to now. And of course, we have to also consider fintech players that are finding innovative solutions to overcome some of these obstacles on the supply and the demand side. So I think there I would stop for my initial comments and just pinpointing some of the main findings that we've seen through our work for now. Thank you.
Thank you, Miriam. Thank you for these these main findings. And maybe just to follow up before giving the floor to Rodney, what do you expect to be the lasting effects of the pandemic and maybe the associated policy priorities going forward?
Yeah, thanks. Well, I think I mentioned a few of them before. I mean, I think the issue of managing SMEs, helping SMEs to manage the debt that they may have taken on during the crisis, and to monitor, repayment rates and non-performing loans. That's something that would probably have an impact, in the coming years. I think another important point is in relation to how to mobilize savings that have accrued in households and in businesses to really fund long-term investments to meet the challenges ahead, the ones I mentioned relating to digital and the green transition, because we know that a lot of the financial support has been short-term in nature, focusing on cash flow issues and making sure that businesses stay afloat. But now we need to look at how on the impacts on longer-term investments and how to mobilize all the savings that have built up in the economy. Another point I think is one that was mentioned by Monica we think is very important, relating to non-financial services that need to accompany financial support. Because of the challenges, the specificity of the challenges ahead, in digitalization and in greening, where it's not just a question of providing funds, but it's a question of building capacity and building skills among SMEs, managers and employees. That's another area that needs to be looked at closely. And finally, I would just say the last point is in relation to SMEs and how their needs are being reflected in the recovery packages that are being rolled out right now. Because what we've seen is that while crisis support has focused specifically on SMEs, this is much less the case in the recovery packages, which are more structural in nature, more general. And so we need to make sure that SME needs are reflected in those packages and that they have the ability to tap into that support, which is really exactly what I was mentioning before in the way of funding long-term investments. So thank you.
Thank you, Miriam. Point well taken, and we'll speak in a moment to the SMEs themselves to hear about what they think of their debt situation, the need for long-term investments and the non-financial services so that they need. For now, I'm turning to Rodney. Rodney, we know that public banks stepped up to support SMEs throughout the crisis. Now, thinking towards the future, there are a number of overarching challenges, such as the long-term investment that Miriam was just mentioning, financing for digitalization and the net zero transition. She also made these points. Can you tell us how the British Business Bank is helping SMEs access finance to meet some of these challenges?
Yeah, thank you, Isabel, and good afternoon, everyone. Yeah, so I think I'd just like to start off by introducing a little bit of what the bank is. I mean, we were founded relatively recently in 2014 in part as a response to the lack of diversity and resilience in the financial markets in the 2008 financial crisis. So there's obviously some similarities that we're facing right now with the COVID pandemic and economic crisis. I cover net zero policy in the bank, working closely with the UK government on this issue. I'd like to thank the OECD and CEB for inviting us to come along today. I've worked in and around climate finance for many years now, including at the OECD, so it's great to be back. And we very much welcome the opportunity to explore some of these issues, because as mentioned in the intervention so far, I mean, it's SMEs facing challenges from net zero, COVID recovery, including levelling up or inclusion, that are very important on one side, but also important that there are benefits and opportunities from this. So it's around how does an institution like us, being the UK government's sort of sole institution for helping SMEs access finance, how do we support both the opportunity as well as help them through the challenges? So I mean, the question that's asked of what we're doing is very important to us, and I think in response I would probably like to talk about a few things. So that the first would be how we got to where we are today. I mean, there's a lot in the last 18 months, but I'll try to be quick. The second is how do we see SMEs in net zero, because there are gaps that we're trying to fill, and they're well understood also by OECD colleagues and those on the panel here. And third, how do we see our own role in net zero, given that we're quite early in that journey? I'm focusing on net zero because that's the sort of topic I'm most relevant to, but I'm happy to follow up later with other questions. So on the first point, I mean, the journey in the last 18 months has been staggering as an institution like us. Pre-COVID, we were supporting around 100,000 businesses and SMEs with around £7 billion in investment. That's now risen to 1.6 million SMEs and around £80 billion in finance in, as I said, just a very short period of time. I mean, it's very dramatic. It's quite expected in given the scale of the crisis and our role to act counter-cyclically to the market, to step in when the market will typically step away. Rather positively, I mean, the excellent report that was just released by the OECD this week noted that 55% of the SMEs in the UK had access to government support, which compares favourably to the OECD average as a whole. And as such, us as an institution are well positioned to support the ongoing recovery as we look to this sort of sustainable future. And there's a very unique opportunity to sort of back the green recovery and resilient one, as well as championing small businesses that are driving the change, as mentioned already. I mean, we've also been in the specifics. We've also been working with government and designing what the response might look like. So we've introduced a pay-as-you-grow scheme where business loan payments are maybe deferred or paused until growth is stabilized. We've introduced a new scheme called the Recovery Loan Scheme, which is there to help businesses recover and grow, and is also scheduled to run to the end of the year. And several of our existing packages were already facing large demand, such as our startup loan scheme, which is helping entrepreneurs start their own business for the first time. And since 2012, that scheme has been running. A third of them have been unemployed at the time of application, which is very positive, given the target of that individual product. So I think it's very clear that there's been a definite positive shift from the sort of survival mode and our counter-cyclical role in the market to something more recovery, which is very much a live topic, but a very positive one, given the starting point. Secondly, on how we see SMEs in net zero, I think this is a well discussed topic, but perhaps very well identified as the significant gaps in understanding of their role and contribution to net zero. As we know, they're very diverse, and many businesses will see net zero as an opportunity, while others find it challenging. I think that's fairly safe to say, and the bank will take steps to support both groups. The importance of SMEs cannot be stated more clearly. The fact that they're fundamentally adopters and innovators of technologies to help meet such targets such as net zero, and they're also diffusers of these technologies through the wider supply chains of economies, which is fundamentally important to how an economy, like in our case the UK, will meet its net zero ambitions. However, we know that they often lack the agency to invest, the knowledge and the capacity to do this investment, which is where an institution like us would have to come in with government to help that. And apologies for the drilling in the background. I think there are three questions that are recurring here, which is whether can SMEs actually take this climate challenge? Do they have the means to do so? And can we help them? I think in answering that question, it's very important to understand the population is very diverse, obviously, but there's also going to be SMEs that are those that are born green, and those ones that are having to exposed to that transition, that we'll have to take steps to try and support both as much as possible, and being able to champion SMEs in this discussion with the wider finance market. Apologies for the drilling. I think on this point here, I think it would be to say that the finance obviously plays a really important role in the policy landscape, and it's important but it's also important to consider finance as part of the wider context of policy that government have available to them to help the net zero transition. So in short, finance alone cannot drive this transition, and I think this is something that is well understood in the OECD, given their work on sort of enabling policy landscape. Just before the drilling gets too much, I think I'd like to spend a couple of minutes on now where we are on our own net zero journey. So we're relatively early stage of, obviously. The discussions go along a lot further than net zero into sustainability issues, where we're developing a very robust ESG strategy across the bank. I'm working currently on a net zero strategy to help guide our activities in this space for the next possibly 30 years. So this is a very long-term timeline here, and it's important to consider the sort of demand and supply side issues at the same time, and make sure that it's not just the finance tools at our disposal, but it's also about the ongoing provision of expertise and understanding of how the finance markets are best addressing SME needs. I think I'll just close there, actually, in case the noise comes back. But I very much welcome the opportunities to work closely with the OECD and CEB and peer and like-minded institutions on this topic, and I look forward to how this work progresses along the way to COP and after. Thanks.
Thank you, Rodney. And we did hear the noise, but it was really bearable, so don't worry about it. Otherwise, we would have cut you off, I guess. So no worries. No, points well taken on the role of institutions or like yours and in all public development banks, in a way, the counter-cyclical role. Also quite interesting to see how you managed to design tailored instruments, and I think this leads us also to Gerard now, who represent the SMEs. And I would like to know, Gerard, to tell us what is it that your members and the SMEs they represent are telling you about their challenges and their priorities. I mean, hopefully it's totally in line, I have no doubt, with what we've heard before. And the policy responses, are they sufficient to meet these challenges? I'll also add in there, Gerard, the notion of disparities or differences between countries and regions in the EU. It would be interesting to have your take on that also, because then we can link in with what Andrés is going to tell us. Thank you.
Yeah, thank you very much. Good afternoon. and thanks for allowing me to present the SME point of view here. A little bit challenging to discuss all the challenges and policy responses of SMEs within 7 minutes, but I will at least try to tackle some of them. To be very frank, at the moment, our members, not only the SMEs, but also our national organizations are very, very much busy still with the COVID crisis. And it's very difficult for us to motivate them to discuss with us and to think with us the next step on transition to greening and digitalization, etc., etc. What you have seen and why we are in this difficult situation at the moment is that the crisis turned out totally different we have assumed in the beginning of it. At the beginning of the crisis, the situation was lost turnover cuts, income losses. 80% of SMEs in Europe reported a reduction of turnover, and there was a liquidity problem. And this liquidity problem was very, very well tackled by the national governments with the support of the European institutions. And we have seen a very fast rollout of the different instruments, which were very, very helpful to the extent that in reality, the insolvency rate of SMEs is last year or till now de facto is much lower than in normal times, which means we are still SMEs in the market, which in normal times would already been out. But due to the fact that the crisis took much more time than expected in the beginning, also this liquidity problem turns in a problem of over-indebtedness in many companies, because the loan moratoria has to be paid back, the postponement of tax payments has to be paid back, etc., etc. And so now we are in the phase of the restart or of the recovery, and the SMEs are sitting there with much higher debt levels than in normal times, which makes them more or less impossible to start investing or to innovate without additional help. And therefore, what is at the moment really crucial is to help SMEs to recapitalize them. And recapitalization of SMEs means different things depending on the size of an SME. Because a very small company, one person entrepreneur or a micro enterprise, they cannot go to the equity market for capital. They need de facto solutions which go in the direction of transferring existing loans into grants, for example. This is now allowed at European level, and I know that some countries, they're doing it. Other normal SMEs may need some quasi-equity injections coming from European programs and national programs to help them to get a more stable capital base, allowing also banks to keep on lending to them. And the next step is, of course, that the ability of banks to lend further to SMEs to help them to restart after this crisis. And here we have the problem that with the end of the loan moratoria and the end of the special treatment by the supervisors, banks are less able to take more risk in their balance sheets, which is not a good decision on the banks, but this is just a situation which leads to a situation that SMEs are reporting de facto since the end of the year, last year, that the credit conditions are tightening, which also makes it more difficult. Therefore, even viable SMEs, which have a good business outlook, independently of the question how to identify them, this is also a big issue in our debate. Also, even these companies need support measures, and therefore we worked a lot with the European Investment Fund, with the European Commission, also in the preparation of the national reforms and recovery plans in the different member states to make sure that such instruments are provided. The outcome is at the moment not fully convincing. We know that in many countries the discussion is ongoing. Many governments say we will wait a little bit till we see what's happening. Some moratoria are still ongoing. We have still countries where insolvency procedures are postponed or keep on hold, etc., etc. So here we are in this phase where we try to convince governments and intermediaries to stay ready or to come forward with measures to help SMEs for this restart. Our figures at the moment show that about 30%, 10% on average in Europe, SMEs are at risk of insolvency, and in some sectors mentioned before, hospitality sector, etc., it's up to 30%, which may be on risks, and therefore also, and some of them will, of course, become insolvent, and we need also procedures, fast procedures for restructuring. We see in some countries, or in many countries, there's not enough capacity to deal with an insolvency wave, etc., etc. So here are the challenges we see currently. Coming to the more midterm challenges, the transition to green and digitalization. It was already mentioned that financing is not the only problem, but is a big problem here. The other problems are lack of skills. We get much more complaints from companies that they are not finding the people to do the greening and to the digitalization. Then we get complaints at the moment that they have not the money for it. The second point is even the countries have agreed to go to zero levels, but 2050 or whenever. SMEs don't see the way to achieve this. So the predictability of regulatory environment is not existing yet. So we have to define much more carefully what will be allowed till when. I always use the example, if a construction company now wants to buy a transporter, they have to know how long they can use this transporter to drive into a city center. Otherwise, they will not buy it and will wait. The same is true for a bakery. If they want to buy a new oven with gas, they have to know how long they can use this, etc., etc. And this regulatory framework, with providing predictable conditions for investments, is at least as important than the financing side. And of course, then SMEs, especially micro enterprises, need also the support structures, advice, and mentoring to go into this process. And then having really this difficult situation as regards financing, then we have to deal also with the new challenges related to sustainable finance, sustainability reporting, etc., etc., where on the one side the regulator says, okay, we exempt SMEs from the taxonomy, we exempt SMEs from sustainability reporting, but in the consequence, SMEs will be affected by them through the trickle-down effect, because supply chain will ask to report to them to make the bigger clients able to do their reporting. Banks will ask to get the ability to report that they have green portfolios, etc., etc. And in reality, we have still no real solution how SMEs could become capable to do this reporting. And the last point I would like to touch here, with the rest we keep for the discussion, is what Isabel said about the differentiation between countries. And even within the European Union, we see, of course, huge differences. On the one side, as regards the impact, countries which are more dependent on tourism are more impacted than those who depend on industrial production, of course. We see, but also the capacity of governments to react on this crisis. Some countries put forward much more money than others. Not that they have spent so much, but 50% of the programs notified to the European Commission was notified by Germany, etc. This is quite impressive. And the third point, this is also very important, is that the institutional setup as regards promotional banks, guarantee systems, how fast banks can roll out programs, etc., intermediaries can roll out programs, differs a lot between member states, and this also has a huge impact on the capacity to support these sectors. I will leave it here for the moment And I hope we can come back in the discussion to some of specific points. Thank you very much.
Thank you, Gerard. And a few points that I've noted, I may mention them again when we're closer to the end of the session, which is already nearing because we're really pressed for time today. So I'll turn immediately to Andrés. Andrés, as we've just heard, and as you know from your work and research, conditions can vary quite significantly when it comes to access to finance between countries, regions, between urban and rural regions, and as Gerard just pointed out, depending on the industry that dominates a certain region. What is the role of local institutions in fostering SME access to finance? And I will add as well, if you maybe have you found some key enablers for financial institutions and public development banks for mobilizing financing for SMEs? Thank you. You're on mute, Andrés. Thank you.
Thank you very much, Isabel. So, and welcome everyone. So good afternoon. To this audience, it's not a surprise that many firms across Europe and in other parts of the world are credit constrained. And this credit constraint of these firms represents a major dent for the potential of those firms to become much more innovative, to achieve greater productivity, to hire more workers. On the whole, what we can say is that this credit rationing represents a significant loss of economic potential for places that are, especially those places that are declining and or lagging behind in particular. But the credit constraints do not affect all types of firms in the same way and all types of places in the same way. They frequently affect, to a far larger extent, firms in less developed countries and in the less developed regions within those countries. Of particular interest for this type of seminar, they hurt smaller firms to a much greater extent than larger ones. And last but not least, they tend to be far greater in areas where the quality of government is lower. To give you some idea of how these factors actually pan out, how they combine on the ground, the effects of credit constraints on productivity for the average micro and small size firm located in a region that is at the bottom of the scale in European terms, in terms of government quality, they are 32% higher for micro firms and 20% higher for SMEs than if they were located in a region at the top of the scale in terms of government quality. By contrast, the difference in the same dimension for larger and medium-sized firms would amount to 9% for medium-sized firms and 8.2% for large firms. So small and micro firms are at real disadvantage, especially when they are located in in regions and places with a lower government quality. We can say that overall, the negative returns of credit constraints on productivity are almost 3 times greater for a micro firm located in a region with the worst institutional quality than for a large one that is located in a European region that boasts the best institutional quality. Hence, and this is focusing on your question, Isabel, clearly, weak government and weak government quality not only affects the capacity of firms to operate in the market, it also contributes to limit their access to funding, for example, by weakening the opportunities for trade credit through production transactions. The study that was mentioned by Monica and that Monica Scatasta at the beginning and that we conducted for the Council of Europe Bank clearly showed that in the case of Europe, good institutional quality is absolutely fundamental for mitigating the negative returns of credit rationing on firms' labor productivity. What we found was that improvements in local institutions, such as increasing government efficiency, working on improving transparency, reducing the levels of corruption, actually attenuated the negative returns of the credit constraints and also facilitated that firms that were traditionally credit constraints could get more access to actual credit. We found that improvements in government quality actually compensate to a considerable extent for the negative effects of credit constraints on firm level productivity. Good and high quality institutions providing this regulatory framework that Gerhard was talking about, for example, can increase the overall level of trust and reputation among local firms, which in many of these, let's say, poor institutional contexts become far more inclined to operate in a way as to alleviate many of the credit restrictions encountered by business partners in the financial market. So consequently, improvements in institutional quality would mean that firms, and in particularly micro and small and medium-sized firms, do not have to rely just on their own internal resources, as many of them do now, or that they have to go to less conventional sources of funding, and they can actually invest more in a more traditional way, and therefore, as a result, innovate and produce more and of a better quality in a more sustainable and resilient way. Hence, improvements in regional institutions can push the productivity up directly, and they can also play a more indirect positive role in softening what is the negative productivity blow of credit rationing. If I were to summarize this, I can say that overall this lack of adequate access to credit for firms, and especially for micro firms and for SMEs, represents a fundamental market failure, not just in Europe, but in many parts of, I was going to say the developed, but it's also the emerging world, with serious consequences for the economy. There's a need, as a result, to promote schemes aimed at supporting the capacity of commercial banks and other financial institutions to lend to micro firms and SMEs. And by doing this, we're addressing this market failure that I mentioned before, and we can make a crucial difference in terms of mobilizing local potential and increasing innovation and productivity. However, and particularly in areas with a lower institutional quality, incentivizing financial institutions to lend to small firms on its own would not do the trick. There are a lot of other problems. It was mentioned several times by Miriam, by Gerhard, the problem, for example, of capacity and local capacity, but also weak government quality, the presence of pervasive corruption, low levels of transparency and accountability, are factors that not only affect the capacity of firms to operate, they also contribute to limit their access to funding by weakening the opportunities for trade credit through production transactions, for example. So there's a need to include measures to facilitate access to credit that need to be complemented with interventions to improve institutional quality, and especially those that are far better targeted at, I would say, 3 dimensions: improving government efficiency and capacity building at government levels, increasing transparency and participation in the whole process, and reducing corruption and nepotism. After all, we have to remember that access to credit for firms works far better in local ecosystems. This system that Monica was talking about, that Miriam was talking about, where firms operate under what are clear norms and rules that are understood and respected by everyone, and in particular, that are understood and respected by all economic actors.
Thank you, Andrés. You made the point on the market failure and how financial institutions can step in. I have to apologize because we were planning on taking some questions and having some more discussions, but the clock is ticking and we won't be able to do that. We will, however, monitor what's in the chat and try and respond to all of you. I think this event was short and sharp enough not to require a full-fledged wrap-up. We had a good overview of the challenges. We've heard from some of the people who do the best work in the field. We also heard from the SMEs themselves, needed for financing, recapitalization, but beyond financing, also the problem of lack of skills and people with the right skills in the medium term, a need for stability in the and adapted regulatory environment for the SMEs to be able to project themselves. The credit constraints, Andrés has told us, are affect much more smaller firms and affect firms where there's a lower quality of government. Gerard mentioned the higher risk of insolvencies. So this is actually a good link to leave the floor to Stefan Raas from the OECD, who will be joined by four equally fantastic speakers. And they will now tell us about the risk of SME insolvency crisis and what to do about it. So I want to thank our four panelists. Again, I wish we had more time to have a discussion, and we may have to do this another day. Thank you everybody for listening in, and Stefan, the floor is yours.
Thank you so much. Dankjewel, Isabel, for a great first panel, and thanks to the Council of Europe Bank for partnering with us in this event. My name is Stefan Raas, and I work as a policy analyst in the Division on Entrepreneurship and SMEs of the OECD. And it's a great pleasure to moderate this second panel on what I think is one of the most important issues that we currently face in the land of SMEs, so to say, which is the question, should we fear a strong rise in SME insolvencies in 2021? And of course, then the question, what we should do about it. To briefly sketch you the background, but I think Gerhard and others said a number of things about that already in the first panel. What we've done in the OECD is monitor the impact of the pandemic on SMEs and entrepreneurs since March. And what we saw, and what was also underlined in the first panel, is how much SMEs were at the epicenter of where it hurt, where the pandemic hit. More than in 2008 and perhaps on earlier occasions, this was a crisis that hit SMEs very strongly. And second, and that was said before as well, government stepped in to support them successfully in many cases, in the sense that the drop, that there was not as large growth in insolvencies as some people expected, but the way that they did was to a large extent through debt finance. And that leaves us now in a situation where there is still the fragility of the environment, there's the reserves of the SMEs that may be depleted, and there's their debt increasing, with the question, indeed, how many of them are still solvent. The question is also what to do about that. The economic department of the OECD, and I shared a link in the chat in a moment, in January 2021, made a paper on insolvencies and the debt overhang in the COVID-19 context, which discusses a number of policy options to flatten the curve of crisis-related insolvencies, as they put it. The paper acknowledges the precariousness of smaller entities and the need to take their position into account, and suggests a number of policy options to do so, from equity measures to more indirect measures related to future tax payments after recovery, debt restructuring, and reform with insolvencies procedures. I'm really glad, and if I may say proud, that we have such fantastic panel, and you see them on the screen here in front of you to discuss this issue today. First, we have Federico Diaz, who is an economist at the IMF Research Department and the co-author of an excellent research paper on prospects for SME insolvencies. Second, we have Martin Goderman, who's head of group funding at the Pro Credit Holding, which is a group of development-oriented commercial banks focused on Southeastern Europe, I believe, and South America. Third, we're very glad to have Felix Haas, who's the head of unit, including for SME policies at the European Association of Guarantee Institutions, the AECM. And last, but certainly not least, we have Rudy Arnout, who is a senior economist at DG GROW, the European Commission, and a professor in corporate finance in Ghent and in Nancy. Each panel member will have 7 minutes for a presentation, and after the presentations, we hope, of course, to have some time for debate and Q&A. So I encourage you, like Isabel did, to put your questions in the chat so that we can bring them forward after the initial presentations of the speakers. We'll start with Federico. Federico, the IMF have done very important work on SMEs during the pandemic. Could you present the main findings of the paper with regard to expected SME insolvencies and what implications you think that should have for policy? Federico, the floor is yours.
Thank you, Stefan, for the kind introduction. As you mentioned, we at the fund released a few months ago a staff discussion note that addressed precisely the fact of what are the insolvency risks that are posed by COVID to SMEs. So I'm going to be basing my remarks on this document that I put out about 3 months ago today. And basically, the usual disclaimer applies as for all fund work. That is our opinion, not necessarily that of management or of the board. If we could now move on to the next slide, thank you. And to start with some background and motivation, as we all know and was already discussed in the first panel, SMEs have been hit disproportionately hard by both the outbreak and the lockdown orders, partly, or at least for two reasons. First of all, SMEs do tend to have thinner equity and cash cushions than the larger counterparts. And also, SMEs tend to be more prevalent in those sectors that are more contact intensive, and therefore they are more affected by lockdown orders. Government actions have contained the liquidity risk quite well, but nonetheless, we believe that solvency risks are building up. And why does this matter? Well, because these could drag the recovery through at least two possible channels that one could think of right off the bat. First, there could be a debt overhang problem, thereby affecting or where firms let pass some otherwise profitable investment opportunities. And secondly, as SMEs account for the majority of jobs, especially in the countries that we consider in our analysis, this could put some economic and social pressure or social stability concerns as well. So what we do in the paper, and I'm not going to go into the details, but just to frame the discussion a little bit, is to analyze SMEs from 20 countries, mostly from the European Union and the Asia Pacific region. And given the shocks faced by firms since the outbreak, so basically shocks regarding to lockdown orders and teleworkability as a result of that, or shocks regarding the whether consumers shy away from certain sectors, like basically think of it like entertainment opportunities or restaurants or so on. And also like encompassing all this, what was the overall behavior of the macroeconomy? So basically what we think is happening to the economy at the aggregate level. So taking into account all of these shocks, we quantify what are the insolvency risks for SMEs in our selected advanced economies. And we also point out what are the implications in terms of jobs at risk and financial stability concerns. In addition to this, we assess alternative policy options that could somehow address these concerns, with a particular focus on quasi-equity injections, as these could, we believe, provide a way to dampen the potential wave of insolvencies. So now I'm going to show in the next few slides a little bit of the quantitative work that we did. So starting with this slide, this would be, let's say, our baseline or our main numbers. On the left, we have the projected share of SMEs that we think will be under distress, either last year or this year. And as you can see, we consider two measures of distress: liquidity gaps, so not having sufficient cash at hand to cover financial obligations, or having negative equity. The bottom line is that somewhere between 15 to 17% of SMEs will be under distress. And in the graph on the right, what we assess is how stable are these projections to alternative scenarios, right? So what would happen if the economy, the world economy as a whole, grows faster? Or what would happen if instead we have more lockdown orders than we thought? Or we can also think it the other way around, we have less. Or what would happen if the changes in consumer behavior turn out to be more or less stable over time than what we thought? The bottom line is that if either of these last two things, so basically more lockdown orders or more enduring changes in consumer behavior, will greatly affect, has the possibility of greatly affecting the share of firms that will be facing distress. So basically, for the interest of time, just comparing on the right chart, the leftmost pair of columns to the rightmost pair of columns, you can see that things can increase quite rapidly. From just comparing the blue lines, we could move from a 9 percentage point increase up to a 12 percentage point increase just by extending slightly lockdown orders or having the consumers changes in consumer behavior being a little bit more persistent. I will come back to this perhaps towards the conclusion on the importance of these numbers. But in the interest of time, and now moving on to the following slide, as you can imagine, whenever we have a significant share of SMEs being under financial distress, this immediately translates into having jobs at risk. And as you can see on the left chart, we have somewhere between roughly 10 to 16% of SME jobs being at risk as a result of COVID. This is quite I mean, as you can imagine, given that SMEs account for 60% of overall employment, these are very, very sizable numbers. To provide a snapshot, this accounts roughly for the overall unemployment in the European Union in terms of overall numbers. So potentially the risk could be high. I'm not saying that is going to materialize for sure, but what this would imply is a very sizable numbers. And similarly, this also translates into increased or sizable share of overall SME debt being at risk. In the paper, we also extend this a little bit further and explore how this in turn affects the financial stability concerns by looking at banks. But I'm going to abstract from that today because I'd rather focus on SMEs themselves. But bottom line is, as a result of firms being in greater financial distress, we also expect jobs to be a sizable increase in the share of jobs at risk, and also some concerns in terms of debt at risk and financial stability. Quite moderate, they are still sizable. Now, what do we do given all these facts that I just foreshadowed? And if we could now move to the following slide, please. Basically, our take is that so far, governments have focused their aid or their support mostly in terms of liquidity, and rightly so. But nonetheless, there are solvency concerns that are building up. And therefore, we need to rethink things slightly, or not so slightly, perhaps. It's up to you to decide how slightly this is. So that basically, to put some more specific ideas. Conventional advice usually entails providing liquidity support to firms that are illiquid now, but otherwise solvent, and to restrict instead any solvency support to typically large systemic or strategic firms. However, things might be slightly different this time around, because there's a larger wedge between what is the private and the social cost of letting a significant fraction of SMEs fail. Why is this? For various reasons. We can think perhaps of the mere magnitude of the crisis that is such that we have really at place potentially very, very large macro amplifiers. There's also the case of the risk of potential bankruptcy congestions if, for example, a creditor takes out an SME to court, right? That creditor will not internalize that effect that has on the overall system as a whole if everyone proceeds that way. And therefore, courts may become congested, and firms that could have been restructured end up being pushed into liquidation, and that we don't want that either. I can comment a little bit later in terms of what we have actually seen in terms of bankruptcy, but just for the sake of keeping the argument, I also like to flag now a third potential factor is that really the mass uncertainty that there is at the time. And why is this important? Because whenever one wants to provide certain amount of support, one really needs to understand what is the firm that is being supported. How does that firm look like? What is the condition, and what are the prospects of that firm? And one of the things about COVID and this and the crisis is that it's really, really hard to understand what are going to be the what are going to be the prospects of a firm in the post-COVID world. In other words, looking at the balance sheet today is not as informative of what is going to happen tomorrow as one could consider in previous crises or in normal times. So there's really a lot of uncertainty surrounding who are the firms that are perhaps more likely to be quote unquote saved. Nonetheless, or besides all these considerations, what matters is that liquidity support per se is not going to address solvency issues, right? I'm not going to spend too much time explaining this difference, but think very, very simply. If you provide for firms support in terms of loans or some kind of guarantee that ends up being as a loan, that provides cash today, but basically increases debt tomorrow. So that does not solve the potential solvency risk. Basically, equity does not strengthen as a result of that. So one needs to really think about how to provide some kind of support that increases the solvency or strengthens the solvency position of firms. Now, doing this, typically or historically, this is typically done for large firms that are publicly listed, where it's a very clear understanding of what their numbers are, what does the balance sheet look like, and they are a limited number. Of course, SMEs are definitely nothing like this. So basically, their financial information is not as clear-cut as for listed firms, and we're talking about potentially millions of firms. So of course, there's the implementation of any such support is much, much harder. And one needs more to consider or to tailor whatever support to country-specific circumstances and to address these major design challenges that I was just saying. So what will be some rules for this? So this solvency support, it's of course more likely or more easier to take place in those countries that have more fiscal space, that have high quality of governance. They have more transparency, more accountability, and more administrative capacity. But even for countries such that tick these boxes, there's still major uncertainty surrounding, as I said before, what will the post-COVID world look like? What are the prospects? And why is this important? Because this makes it harder to target the right firms that you want to save in some sense. This raises, of course, the key issue here is what kind of firms are the right firms to save? Typically, these right firms, quote unquote, would be when one considers viable firms, those that have a sound business model going forward. But as I mentioned before, given the mass uncertainty surrounding the crisis, identifying these is very, very hard. Still, targeting is absolutely key for providing this kind of support. In the paper, what we show is that, in fact, the efficiency gains from a targeted support program vis-a-vis a blanket support program that provides support to every firm without much distinction among them, it's really, really, really substantial. So there are efficiency gains of the order of 4 in terms of right firms save per dollar spent whenever you target. So targeting is absolutely key, also to keep the fiscal cost in check. So how do we approach this? There are a number of options being considered in the public square. We mentioned roughly a few there in that bullet where the mouse is right now. One option is to provide hybrid instruments that bolster equity, and here it's profit participation loans, for example, would be a case that it strengthens the equity position, and it's a debt that it's junior to all others, and somehow, quote unquote, bets on the firm's recovering eventually. And similarly, grants being paired with future profit taxes is another way of giving money today and recovering later through higher taxes in the future once a recovery takes place. But the important thing is that in any design that one thinks, it's important to have the private sector involved. And therefore, one can condition support on the private sector providing equity injections as well. Still, regardless of all this, sharp traders will remain nonetheless. So basically between the potential massive cost in terms of bankruptcies versus the potential very, very steep fiscal risks. And at the same time, there is the more traditional trade-off regarding whether one wants to provide support in order to preserve firms and or jobs, or one would like to let the market work out in some sense and allow for a factor reallocation. So if we can now move to the next slide, just to conclude, because I guess I'm running out of time. Basically, what we find is there's a sizable increase in solvency risks, especially for SMEs, even under our economic recovery baseline. And why is this important? Because insolvency concerns are not addressed by credit provision. There are two main challenges to do this for policymakers. First, technically, it's very, very challenging. And second, it could be quite costly. What I said before, the efficiency by dollar spent in terms of blanket versus targeted approaches, and risky in the sense that one is betting on a recovery. And bottom line is we propose a three-pronged policy response. First, to continue providing liquidity support as needed. Secondly, these quasi-equity injections who are appropriate. I mean, the specific design should be really tailored for specific circumstances. That's why I kept my comments at a rather high level. And thirdly, even though I did not comment this much, we need stronger SME insolvency procedures and debt restructuring mechanisms. This is important because if we want to have basically distinguish those SMEs that should be restructured from those that should be liquidated, this should be done in an efficient and speedy way. So we need, and most countries do not have the structure to handle this. So we need perhaps out-of-court mechanisms or prepackaged SME-specific hybrid mechanisms in place to make this really something much more efficient, and that gives us a better outcome that would otherwise would be the case. And I'll stop here.
Thank you so much, Federico. That was a very rich presentation of what I thought was an excellent paper. I mean, one of the issues that you put on the table is how can we suss out what's a viable firm or not? And I hope that other panel members will say something about that. There's a number of interesting questions being put in the chat already. So I hope that we'll get a good debate. We next go to Martin Goderman as a speaker. I see that the ACM slides are being put on, but I think, Martin, I'd first like to go to.
I try to share my screen, then I think maybe it's easier.
Yeah, but I think that we first need to maybe the technical people could. Voila, I think now you should be able to share your screen, Martin.
Okay.
And Martin, thanks, of course, for joining us. Banks have a lot of stakes in this debate on insolvencies, but they're also very able to check the temperature, to suss out how their clients, SMEs, how things are going. And we'd be, of course, very curious to hear a bit what your experience is and your expectation is in this respect. So the floor is yours.
Yeah, thanks a lot for the invitation to participate in this forum. Yeah, I think the keywords you mentioned are temperature of SMEs, our experience, our expectation with SMEs. I try to share with you now a bit our background so that you know where we as ProCredit as an SME group come from, share with you the overall context in which our clients operate, share with you where we think SMEs stood last year, they stand now, and they will stand in future, and maybe finally link it as well a bit to what government, what authorities can do about it. I think you see the screen now. Can you see the fact sheet? Can you confirm?
Yes,
okay,
we do.
Good.
Yes.
Look, I would like to use this one. Basically, it's a short portrait of ProCredit as a kind of guiding principle for me to address a couple of these points. So if I start with who we are, let me see whether that works with a pointer. Pointer option highlighter. Let me see. Oh, it doesn't work. But do you see the you see my mouse moving, I hope. Do you see it, or can you just confirm? Okay, good. So basically, who are we? We are a banking group. 94% of our loan portfolio is in SMEs. So basically, SMEs are our DNA. 93% of our loan portfolio is in Eastern and Southeastern Europe. Means if I start from the East, so it's Georgia, it's Ukraine, Moldova, it's Bulgaria, Romania in the EU, and basically it's the Western Balkan. We have a total loan portfolio of 5.5 billion. So this as a kind of background, who we are, where do we operate? Now, to understand a bit the risk profile, the performance of our clients, one needs to have a look at how does the GDP look like in our countries. What you see here is the outlook from the WEO, so World Economic Outlook. They forecast 4.5% growth. What is even more important, I think, is to look at last year. So in most or in many Western European countries, we saw a dip in GDP by 10% or even more. We haven't seen anything comparable in Eastern Europe. So the decline in GDP was well below 5%. In a country like Serbia, even below 1%. So if we talk about economic, disaster, economic recovery, it's a different background compared to countries like Spain or Italy or France, whatever country you name. I think this is important to also to see as a background when we look at what's the risk profile of our clients, how we see the SMEs. Now, if you look back at the starting point of the SME of the Corona crisis, let's say February, March last year. So we were setting, of course, as every other institution sitting together. So what are the main challenges? The first one is, of course, adjust operations to the new reality, which was for us relatively smooth, given the fact that we already, until then, were relatively digital as a banking group. Second point was watch liquidity. And that was a different dimension of challenge, let's say, because to a certain extent outside of our control. By and large, and I will share with you the numbers on the next page, but by and large, this problem was solved, I think to a certain extent, to a large extent, due to the very powerful intervention by central banks across the globe. ECB liquidity provision also kind of flowed over to Eastern Europe because many of the banking participants, a large share of the banking sector is dominated by Western banks or European banks. But the third point, the most important point for us was how to immediately talk to our clients, to our SME clients. On the one hand, to see where do they stand, how can we support them? Secondly, of course, with the intention to control our credit risk, to see where do we need to restructure, to act very quickly. But the third point also to spot new business opportunities. So not see it just from a risk perspective, but also from business opportunity perspective. Now, if I jump to the next page, and I would like to highlight this point, here you see how did the loan portfolio develop. So in 2020, we grew by well above 10%, meaning we kind of continued the growth we saw in the previous years. In that sense, I think we very much picked up the opportunity to continue financing our clients and even spot new opportunities. Even more marked was the growth in customer deposits, close to 18%. There's some credit-specific elements to it, like digitalization, etc. But it was also supported by a liquid banking sector. So the least problem we have right now is an illiquid banking sector. The challenge for the banks is now what to do with all the deposits, which they, if they do not invest it into assets, need to invest at minus 0 point something somewhere. So loan portfolio growth, we continue to grow, deposit growth continue to grow. Now, what's about loan portfolio quality? So if you think about credit impaired loans, meaning those loans are really in trouble, let's say, it slightly went up, but not fundamentally. And I also think even being aware of what have been said about whatever over-indebtedness, etc., we don't see it structurally changing in our portfolio. So from that respect, we don't feel, and I don't want to trivialize the situation, but don't feel to be in a deep crisis of there we have a problem with the whatever disastrous SME portfolio, which we need to bring back to recovery. There are challenges, I will address them, but it's not that we come out of a disaster situation, but I think the background SME in Eastern Europe, who already went through a number of crises over the last 10, 15, 20 years is important. I would now come kind of not close to the discussion, but come to other topics. So we grew during that time, and the green aspect was very much covered in the first session, in green loan portfolios by 30%. Currently, it's close to 20% green loan portfolio of overall portfolio. In this context, I think, and I will give an example, green, what we saw is a bit that the green topic was overlaid by the COVID topic, which I think for a temporary time is fine, but we also saw a bit as a setback. We benefited, not just during the time, but in principle, by guarantee programs from EIF. And here the keyword is innovation, guarantee programs for innovative companies. A program which we about to be fully utilized. Unfortunately, it will not be, I think, continue the same way, but here we clearly see a positive role of governments. Or of a quasi-government institution or government EU-backed institutions. So what does it mean for where do we stand now? So I think the keyword at the beginning was what's the temperature of SMEs? So I called a couple of banks this morning just to make sure that I don't tell anything which deviates from what their perception is. So I start calling Ukraine and I said, so Anna, so how do they doing? How is the mood? The answer was, and there was a long answer, but one key element was, look, we have a large loan portfolio in the Ukraine with SMEs. What counts for them is weather and prices. And you remember the drought we had in Odessa last year for the first time in, I'm not sure in history, but for a long time. So the answer is, for a relevant part of our portfolio, climate change is more important than COVID. And I think one needs to keep that in mind. Same call for with our colleagues Macedonia and Georgia. So we went through the sectors. I mean, it's obviously HoReCa, so the hotel, restaurants, cafe sector is struggling, but we don't have too much. Plus, also many of these are family business, and then maybe on the countryside, then they expand the agriculture business. So by type of business, they're relatively resilient to it because they're family-owned business. They can reallocate their resources to a certain extent. Internal transport, to the extent it's related to tourism, is challenging, etc. What is booming is infrastructure, at least in Macedonia, because government is boosting the budget, using it for infrastructure and efficiencies. And companies tend to focus more on improving the operations rather than seeking growth. What's the outlook? The overall, I think, sentiment of the clients is it's a bit of a cautious optimism. Cautious because everybody knows the new whatever Delta version of COVID-19, etc., is like hanging like a dark cloud above us. So the overall kind of scenario and setup, which is relevant for everybody, is to the same extent relevant for the behavior of SMEs, how much they invest, how optimistic are they. And the optimism comes from the fact that, yeah, GDP is kind of picking up again. How does it relate to what I think helps us or helps SMEs? Beyond specific elements like the guarantee program, as I said, EIF Innofin was extremely helpful for us to support innovative companies. I think is a sound health management vaccination policy, because that determines the overall perspective of the SME business. And the second one is, I think, if one can address governments, is have a green agenda, because there you can combine creating stimulus, economic stimulus, from which also SMEs will benefit with a green agenda, with a forward-looking agenda. And that, I think, will help many of the points addressed today. So that's, I think, a bit my view of where we stand in our experience.
Thank you so much, Martin. A more optimistic kind of vision, if I may say so, of course, with a focus on where the portfolio of your institution lies more Eastern Europe. But indeed, if we compare now what Gerhard Humer said in the first panel with expectations of 10% of SMEs being insolvent, that's 2.5 million, I think, just about in Europe. We had the IMF calculations also leading to quite a high share of potentially insolvent SMEs worldwide, and in particular particularly in Europe, but there is also reasons to look at other things, be a bit more optimistic, but also take that climate aspect into account, which I found very, very relevant and important. You mentioned, of course, credit guarantee organizations that helped. And maybe we can straight away go to Felix for his presentation from the perspective of credit guarantee organizations on this issue. Felix, the floor is yours. Your slides are already visible for everybody.
Thanks a lot, Stefan. Good afternoon, everybody. I hope you can hear me fine. Thanks a lot to the OECD and the Council of Europe Development Bank for the invitation. I'm honored to be allowed to speak in this interesting event and to represent AECM in this panel. If I very shortly might present AECM, it's the European Association of Guarantee Institutions. We represent our 48 members from 31 European countries towards EU institutions and of course also towards the OECD. Here you can see a map of our, back here you can see a map and a list of our members. So our members, what are they doing? They are supporting SMEs with a viable business model in getting access to finance via the provision of financial collateral. And now I would like to kindly ask you to switch to the next slide. When the COVID crisis broke out, AECM members reacted in no time, setting up extensive support measures, of course, in cooperation with their respective governments, the European Commission and the EIB group. If I just may illustrate the extent of these support measures by citing a few findings from our statistical yearbook 2020. The outstanding guarantee volume of all AECM members together increased by 200% to the highest ever registered level of 330 billion euros. And the number of SMEs that are in the books of our members increased also substantially to a level of 5.2 million. So for the detailed results, I invite you to have a look at our statistical yearbook, which is linked here, which is linked on our website. I also put a link here to a brochure that we produced that presents in detail the measures adopted by our members. But to switch to address your question now, may I ask you to switch to the next slide, please? We recently had our annual guarantee activity survey. And according to this survey, we found out that nearly 70% of our members expect default rates to rise this year. Next slide, please. So before I tell you how guarantee institutions support companies in such a difficult situation, I will explain how they first assess if a company is viable or if it is a zombie, since our members can only support viable businesses, of course. Identifying viable businesses is the core business of guarantee institutions that offer individual guarantees. These are promotional institutions that are deeply rooted in their respective regions, and many of them have several decades of experience. They know the business structure in their regions, and they are strongly interwoven with important actors in the area of SME finance. And often they know their clients even personally. So all in all, guarantee institutions are in many cases the ideal entities to assess the viability of small businesses. And the identification of viable businesses is of course necessary not only for new financings, but also for restructuring processes. In the case of portfolio guarantees, and I will not go into detail on this, here it's the guarantee institutions just rely on the viability assessment of the financing bank. Not just, of course, they also check, but I leave it with that, and concentrate rather on the case of individual guarantees that are offered by most of our members. And in this case, guarantee institutions analyze SMEs viability on a case-by-case basis. We recently had a conversation with our members to find out how they assess the viability of businesses and if they have scoring or assessment systems in place for this evaluation. As a result, I'm afraid I cannot present you a list of fixed indicators or criteria thresholds that need to be respected to determine the viability. The evaluations mostly allow for some discretion, taking the individual situation of a company into account. This is important in order to allow a maximum amount of companies to survive without, however, taking the risk of large-scale zombie financing. Next slide, please. And I will just present a few of the indicators that our members look at. So they have a look, of course, at the 2019 balance sheet, at the equity debt ratio, at the behavior of the company pre-COVID. Next slide, please. Very important is also the cash flow analysis, the attitude of the shareholder, and soft factors. In the case of startups, the assessment changes a bit. Of course, there's less historical data available, so the analysis focuses mainly on the business concept and the profitability forecast. And what one can say in general is that guarantee institutions take a more flexible approach than in the pre-crisis or pre-COVID period. Next slide, please. But I will skip the next slide in the interest of time and get already to the question how to support companies that are approaching a situation of over-indebtedness. So AECM members continue their support to SMEs, adapting their products to the changed situation and to the needs of SMEs in the recovery phase. As the viability assessment completely depends on the individual situation of the company, so does the choice of the support instrument. And according to their situation, AECM members might continue to provide the classical well-proven debt guarantees to bridge remaining difficulties and to enable the company to dive into the recovery phase with full capacity. It might, in other situations, also look into debt restructuring measures. These measures already have been heavily employed over the past year. And in some situations, less conventional measures might be required. Some situations might call for leasing guarantees, or especially in situations where a company faces, a viable company faces risks of over-indebtedness, equity or quasi-equity measures could be involved. And here, if you're interested in guarantees for the economic recovery, I would like to invite you to our virtual annual event in the end of September. You have the link here on the slide. And on my last slide, I will just present shortly the type of products that our members offer. And most of them, of course, concentrate on gap guarantees, which is their core business. But speaking to our members, it's becoming clear they see the need, especially in the current situation, for equity and quasi-equity products. They are working on such products. Some of them are already offering them, or guarantees for equity, which is not very common, but which our members see the need for. And what I can say is they are working on introducing such products, but it's also not easy because not every counter guarantor allows for such solutions. But this is something that the guarantee sector is currently working on. And with this, I would like to stop. Thanks a lot for the attention.
Thank you so much, Felix, for that impressive overview of what your members have been doing, but also this reflection on what a viable firm is and in different kind of context. I would now also, in the sake of time, go to our last speaker, really Arnoud. Really, I mean, you've heard a number of perspectives here. You maybe saw also some questions that were in the chat there on standardized reporting requirements in the finance context and how European Commission can help SMEs. But of course, this debate as well, I mean, the European Commission has been very active in this crisis and in formulating recovery packages. How do you see this risk of SME insolvencies and indebtedness? And also, how do you see this is and should be addressed in the recovery packages that are currently in development? Really, the floor is yours, sir.
Thank you, Stefan, and thank you to the CIB and OECD for inviting the Commission here. And indeed, I was happy to see this optimistic view of Martin, but unfortunately, most of the figures we have for the European Union are saying closely what OECD is saying in the conclusions and what the International Monetary Fund said. We in our study say 1 out of 6 would have negative equity. 34% of the companies if they draw on cash buffers, they will have financial distress. So this means more non-performing loans, increased default, tightening of credit conditions, widening financial gaps. Everything we heard here today, I can only confirm. And so I'm not speaking about analysis, but what are we doing about it? And not as Federico was saying, what are the potential solutions, but what are we doing? I think that the first thing we are doing is the philosophy is we have to move from survival to recovery and from illiquidity to insolvency. So I think we are really moving the target now. And the first thing, of course, is what most of you know is the famous recovery fund. The recovery fund is, of course, more than access to finance. But if you see now on the 27 projects, 11 of the countries had a window on access to finance. And this is, of course, huge because it's 750 billion. It's bigger than the Marshall Plan. And it's financed in a very strange way because it's financed through bond issuing. This is historically, and people would say only the crisis made it possible, and 30% are green bonds. But that's the first thing. So that's a huge recovery. And this is amounts that has to be committed before 2023. So 750 billion in 2 years' time. This is, of course, huge. But on top of that, we have really what has been discussed, the insolvency instrument. So recovery instrument is up and running. The insolvency is not. And this is, in fact, an answer to what Frederico was saying. Let's focus on quasi-equity. And in our terms, quasi-equity is subordinated loans. So this recovery package is a package where we focus on subordinated loans, long-term, mid-term, which are implemented through the financial institutions. And I agree, of course, it's important that financial institutions are active at all localities and all regions. And there, of course, we are now almost there. We will work through guarantee scheme. We don't know exactly what will be the right level, but perhaps Felix can help me in that. If it is too much, there is more a hazard. If it is too low, then the banks don't have an incentive. So for the moment, we are thinking about something like 70%. So we would guarantee 70% for banks that give subordinated long-term loans and long-term credits to companies. So this is not up and running, but we hope to have it through in July this year. A third level is InvestEU. And I heard before it was said that Innofin is no longer valid, Martin. Well, it's true that we simplified. For once that the Commission simplifies, we have all these programs, Innofin, COSME, we all put them together in one big thing, which is called InvestEU, which has 3 pillars: equity, quasi-equity, and credits. So equity is co-investment with equity funds. Quasi-equity, for those who are familiar with the SBIC program in America, we copied it, but the copy is, of course, better than the original. And it's, in fact, giving quasi-equity to venture capital funds. And even I know, Stefan, in your former function as head of the Dutch presentation, you were one of our ambassadors who pushed this program, which is called Escalar, and which is now as part of InvestEU. And the third is credit. So we have equity, quasi-equity, credits, and this for 4 pillars: infrastructures, R&D, social, and SME. And so there, Martin, you will find back the same philosophy of Innofin, but in a bigger thing. So again, this is about 26 billion, but we hope private involvement, guarantee on guarantee, counter guarantee, that we have a multiplier of 14. So this means that we hope that the 26 billion will mobilize 370 billion of credits, equity, and quasi-equity. The next one, so I spoke about the recovery package, I spoke about InvestEU, I spoke about the insolvency instrument. Let me say one word about the capital market union, because it's of course very important. We still have this issue of the non-integrated markets. And so there you have the second phase, which is making financing more accessible to enterprises. And one of the proposals is what you call the referral proposal. It's a directive in preparation where we ask banks or financial institutions, if they refuse a credit, to forward, e.g. to alternative financing, and to say to the creditor, well, you could perhaps go there because that's a place to go. The second one is to make a safe place for the investors. And there we are speaking about the whole issue, for instance, of financial literacy. And then we are working with the finance competence framework, which we are doing, by the way, together with the OECD, and to say, how can we learn people how to work with financing? And the third pillar of this CMU, the Capital Market Union, is the integration of these capital markets. On top of that, we are working on what we call a pre-IPO fund. It's meaning financing companies that envisage to go on the market, on the public market, but the months before is sometimes very hard to finance. And so we have a pre-IPO fund. And finally, because I really want to leave time for questions and answers, I promised you, Stefan, finally, there's DEBRA. DEBRA is standing for Debt Equity Bias Reduction Allowance. It is the system in Europe where today a lot of SMEs goes for credits, namely for fiscal reasons, because they can deduct. And so we want to do the same, as already a few countries are doing in Europe, that if you finance equity, that you have the same or even a better fiscal advantage. And so that's another directive which is now on the table. Of course, it's fiscality, so we have to go to the council and we need unanimity. So no promises on the issue, but at least it's on the table, and that's what we want to do. So together, my list is not exhaustive, and I want to answer in more detail every one of them. But in fact, this is 5 of the examples that we want to do to cope with the insolvency issue that has been largely discussed today. Thank you, Stefan.
Really brilliant as always. Thank you so much. There's lots of things that I would like to ask you after what you said there, but I'm looking at the time, and I know that we want to be very careful not to extend this session too much. So I would before I pass the floor to Céline Kauffmann for her closing remarks, I want to thank all panel members very much for their input and views. I found it fascinating how we had this balanced and differentiated perspective on the risk. I mean, that might be because we look globally, or we look in a certain part of the world that might play a role. It might also have to do with the kind of role that we play in the institutions that we're in, that the views are different. But what I also thought that even if there's that difference in how optimistic or less optimistic we look at things, that the further engagement in this conversation, not only about the recovery and about tomorrow, at the risk of sounding like a boomer, I must say, but that we must not forget today either. When there are these real kind of challenges for SMEs that may be there, that need to be taken into account. I see a poll is being put in front of you where you can also give your feedback on this. But again, thank you very much to the panel members. And with that, Céline, I'll hand the floor to you for the closing remarks.
Well, thank you very much, Stefan, and thank you very much to the panelists. To me, it's been a very outstanding discussion. We had excellent speakers and many topics that were touched upon. On my side, I don't want to be too long, just to say this is hopefully only the beginning of the discussion, and many topics that we can continue discussing in the future. Let me just highlight a couple of key takeaways on my side that I thought emerged very strongly from the discussion, and where at the OECD, I hope we can continue developing and working on. The first one that came across from the 2 panels is that for sure there's a complex balance that needs to be found and maintained on the way to the recovery. On the one hand, it's clear to all that SMEs have been hit extremely hard by the pandemic. And in many cases, they are still very much struggling, in particular with rising debt levels. And of course, withdrawing support measures too abruptly may put these SMEs in further difficulty and increase insolvency, as many of you mentioned, a concern that was clearly on the mind of Gerhard from SME United in his intervention. On the other hand, the support measures to the level that we heard Rodney from the UK British Bank highlighted, or that Felix showed on his PPP, PowerPoint cannot continue indefinitely, that's for sure. And with recovery taking off in a number of OECD countries, further support will also become less and less necessary. So, you know, going forward, it's clear that countries will need to carefully monitor potential SME insolvencies and take actions accordingly, also because of what Federico really strikingly highlighted in terms of potential job and financial stability implications, and more generally in terms of systemic risks. And the trade-off for governments are not easy ones, and looking at the slides that he showed us, because also targeting of SMEs, while necessary, is really challenging. But I think there was, you know, despite a bit of a gloom in the discussion, there was also some optimism that was actually shown by several speakers, in particular because there are still important action levers that governments have, and there is important knowledge that different institutions also have on the topic. We discussed debt restructuring, equity and quasi-equity support, smoothing of debt repayment, guarantee schemes. We also discussed the knowledge that the banks and the guarantee institutions had on SMEs and their viability. So I think now, as Rudy said, we need to move from survival to recovery, and there are several aspects to that. The way SMEs and entrepreneurs are being included in recovery packages that are currently being developed by countries is obviously of critical importance. And in their aim to build back better, these recovery packages should also probably think small first, more systematically, and take the circumstances for recovery and resilience of SMEs well into account. We need to overcome the immediate hurdles, but also to look to the future. And I think strikingly, from the first panel, we heard that financial diversification that was really on the way before the crisis took a bit of a hit during the crisis. And we need to ensure that we maintain the gains that were achieved before the crisis. This will be very important, and all the more important that the challenges that lie ahead will require different types of financing instruments and sources. We heard the importance of, you know, financing the green transition, the digital transition of SMEs, which will require overcoming specific challenges on both the supply and the demand side. We know, and we heard from Rodney again, that financial institutions will have a key role to play in accompanying SMEs towards net zero. And this is typically an area where the OECD would like to work further with banks to build a platform to share knowledge and good practices in terms of sustainability financing for SMEs. I think what came out strikingly from the discussion is that the challenge of SME transformation is not only a finance one. We heard it several times today, and SMEs themselves must have an important voice in policy discussions going forward on the finance aspect, but also on regulatory issues in relation to the digital and the green transitions, where we need to consider the whole ecosystem and not financing alone. Also because, and I think that was mentioned by Gerhard, even if exempted, which is not necessarily a good solution in itself, SMEs will be impacted by any regulatory requirements indirectly through their supply chains. We also heard clearly, notably from Martin, that there are important differences between countries, across regions, and even within countries. And the evidence that was brought by Andrés on differences across regions is very illustrative in this respect. Local institutions have an important role to play in strengthening access to finance for SMEs and in overcoming market failures. And just to mention that this is a very important point, and that the OECD SME financing scoreboard that is coming up will actually examine the subnational dimension through more granular data on access to finance. So just to, you know, as an appetizer for that upcoming finance scoreboard that we will publish in early 2022, It will also cover and include a thematic chapter on how recovery packages can be leveraged for diverse financing offer for SMEs. So watch out for that publication. It's coming early 2022. And let me really finish by thanking warmly the outstanding panelists that contributed to today's discussion, because I thought the discussions were really outstanding. And I hope that this is only the beginning of the discussion for all of us, and that we can involve you further. And I'll finish by thanking again the two teams from the OECD and the CEB, Miriam, Stefan, Isabel, and Christina, and I'm sure many others in the background that potentially we didn't see on the screen today. So with that, and I see we are losing participants by the second, have a good afternoon and upcoming vacation, I hope, for all of you. So thank you very much and have a good day.